The big lesson to be learned here is that everyone in the industry, including myself, so I'm no different from anybody else, had sort of forgotten just how strong of a correlation there is between cap rates and interest rates, right? So interest rates go up, cap rates go down. That correlation has always been known, but what had happened is in the 2018-19 cycle when the Federal Reserve raised rates, and they only raised them three times, so it was at quarter points each. And so what happened is at that point of time, we didn't see any change in cap rates. In fact, they kept going down. And so I think if the Fed had kept raising at that particular point in that cycle, we would have seen cap rates change. Because it didn't happen, there was this, I think, laziness around, the way cap rates work and the consequences of those cap rates. The other piece of it is that there was this feeling that bridge lending works in all environments, even in an environment where fixed rates are 3% or even lower, right? A lot of multifamilies have 3% fixed rate, 3.5%. So they had the opportunity to go perm, and people didn't take those opportunities because there was this feeling of, well, low bridge rates will be around forever. So now we've come to basically everyone has reset to the standard position of everything moves in cycles, things go up, things go down, then they go back up, they go back down. And that's going to happen to multifamily. It's going to happen to our cap rates. It's going to happen to interest rates. All of the things that are happening to our world, the fact that we are now in the fourth turning, if you don't know what that is, look it up. We're in the fourth turning. That means that every successive year will be more volatile. So I do expect that in the next 5 years, we will see inflation spike again. I have no idea what will cause that spike. I definitely know it won't be something like COVID. It'll be something completely different, but it will cause a spike as well because our economies are becoming more and more fragile. So there will be, interest rate spike. There'll also be an interest rate drop because there could be an event like COVID. COVID took rates to zero. Something like COVID will come along in the next 5 or 6 years. So there'll both be opportunities for us when rates drop and distress when rates go up. Bottom line, people have learned two big lessons. Cap rates can go up, and bridge loans are not always the best. An entire community of people has learned that lesson together because the Jobs Act in 2013 led to crowdfunding in 2014 and created really the syndication industry. Sure, there were a few people around, like my friend Michael Anderson had been doing it, for 20 years. He's retired now, but it was a very, very, very small number of people. And now there's, 10,000, 20,000. Those are numbers that I hear in terms of syndicators. So the entire industry was created since 2014, and no one had seen a down cycle. And so the industry basically is going through a maturation process. And as a result, I think that we will be better, when it comes to the next distress. But as you mentioned, 2024 is still a distress year. So I'm not done with the distress at this point in time. Nobody's properties are fully safe. And so I expect that the distress will ebb by the end of this year. And we can talk more about that. But the reasoning was people, didn't believe in these two things that I just mentioned. And that really led to these challenges. I can tell you that people that had been through cycles, especially larger companies with 100,000 units, a much bigger portion of their portfolio was perm and a much smaller portfolio was bridge, which thank God that happened because otherwise the entire industry would have been distressed. As it happens, the vast majority of these 2,500 properties that could be in distress or are in distress are new syndicators, the vast majority, right? Whereas the industry has, tens of thousands or hundreds of thousands of properties, and the vast majority of those are not in distress.